Who's our next speaker, Seif. Sam is the founder and chief executive officer of Purpose Investments, which he formed following the sale of Claremore Investments to BlackRock in March 2012, and the co-founder of Wealthsimple Technologies. Prior to Claymore Investments, Sam was an investment banker with RBC Capital Markets. He has a strong commitment to the community and is a current member of the Next Canada Board and the Art Gallery of Ontario Foundation Board. Some will talk today about why is crypto so disruptive to financial industry. Please go ahead, Sam.
Thanks, Chris, and thank you everybody for having me here. And you know, I looked at the agenda for the 2 days and you know, quite fascinating. And you know, I think there's a lot of great content that we're getting from these sessions. I'm going to try to just step back and you know, give you my perspective of you know, why I'm you know, very focused on crypto and what it does in my mind to reorder or restructure the mental model of what finance can be in the future. And to go through that, it's also important to understand my, you know, the way I think. So my background, studied engineering at University of Toronto, joined in finance at RBC and capital markets, and worked in the finance industry. Have always kind of attacked or looked at problems from, you know, that beginner's mindset. And, you know, and that's led me into my innovation journeys and in the way I've kind of built the businesses. So as Chris mentioned, my first company I left RBC to build was a company called Claymore, which was really around how can you build a better asset management company. And, you know, I took a large part of the technical components of what a you know, an asset manager would do from an active thinking, you know, fundamental foundational principles of investing, and married them with the disciplines and call it fees and benefits of compounding from indexing, and put them together and created, you know, what would ultimately become fundamental based indexing, discipline based fundamental investing. And that business, you know, profoundly grew quite meaningfully, but it gave me a lot of perspective on what we were trying to do, which was, you know, how do you ultimately kind of mathematically, you know, beat the markets and do things to ultimately win. You know, a large part of it was driven and rooted in the principles of quantitative investment management, which I think has become much more popular today. Anyway, sold that business to BlackRock and then stepped away and sort of thought about, you know, what was the industry, what was happening, and sort of saw a bigger picture of opportunity around, you know, not just the asset management industry, but broadly finance. And sort of said to myself, like, you know, look, there's these really meaningful shifts that are going to happen over the next decade or two, and how technology will ultimately lead those shifts and changes. And again, applied myself to how can we think through, you know, the way that finance can change, be a part of that. All along the way over the last decade, though, you know, I've also seen the challenges that technology alone has in innovating the industry. And so, you know, I've been very focused on innovating in unique areas. So as Chris mentioned, I also co-founded a firm on top of Purpose. I also co-founded a firm called Wealthsimple, which you're probably familiar with. At Purpose, we are, you know, focused on four distinct areas. So asset management, innovation in asset management, sort of continuing on in the journey of what I did previously with Claymore. Wealth management. So how can we really help take technology and infrastructure to change the way that modern wealth experiences are built, specifically when you get into full service like advice. Third is SMB banking. So banking for small businesses. How can you use embedded finance and models around, you know, providing capital and data-driven models around credit underwriting to be able to embed yourself into the world of how a small business needs support from financial services. And then finally, in retirement and the journey of a retiree and the discipline of how you can innovate from product perspective there. But everything I've done to date, everything has been built on traditional financial services mindsets and thinking. And what happened was, you know, when I was sort of in the mid 2015, 2016 timeframe, you know, people started to talk more and more about Bitcoin. And, I started to hear more and more about it. And my mind immediately went to a dismissive approach. And, I kind of talked negatively about Bitcoin and said, you know what, it's probably a fad. It's a scam. I don't think it has much value. And I sort of looked at myself and said, wait a minute, like people are actually quoting what I say, and my message is getting in the market. Before that's not my normal thing to just talk about something like that without actually having some knowledge. So I said, I'm going to actually go and figure out what's going on here. What is this thing, Bitcoin, that everyone's talking about? And I pushed myself to go and learn. And the best way to learn, actually, in my opinion, is always to make an investment. So, I allocated some capital, but I also invested it in a company, and kind of forced me to kind of start to really pay attention. And frankly, that experience blew my mind. When I started to actually dig into what this ultimately was, it changed my entire perspective of what I was dealing with. I think what everyone was, kind of talking about when they talk about Bitcoin is this idea of currencies and things like that. I looked at it and said, this is transformational. And what really got me, of course, was when I started to dig into Ethereum, around nonlinear, models. It really changed the way I sort of looked at it. And it gave me an ability to start to rethink my mental model, which I'll talk about today, about the future of how all, call it agency, asset, or engagement can be restructured. And so I've been on this journey ever since. I've made a number of meaningful bets in this space, but my view is we're still in this really exciting opportunity of change, and we're just scratching the surface. And I think that it's all about people doing their own research and getting in and understanding what it is at its core that really will either energize or excite people to ultimately what the opportunity is. What blew me away, just before we get into it, was this ability to rethink the single block that was happening in my mind to the true innovation in financial services. So what does that mean? So stepping back for a minute, the way I've always, back in sort of 2010, I built a mental model for financial services around, what is financial services at its core, right? And it was all about like post-financial crisis, starting to really think about like, how does this industry work? Like, what is it really there for? What's the value proposition? And one thing that I've done always to simplify things is to really get it down to the basics. And so the way I look at financial services is a very simple business. It is the business between those who have money and those who need money. The entire industry lives between those two parties, whether it's, asset management, whether it's capital markets, whether it's underwriting, whether it's currency convert, like whatever the industry is built on, every profit and loss that the industry is ultimately built on is built between those who have capital and those who need capital. And if you go back in time, the financial services industry was a small relative part of GDP. In and around post-war into the sort of 60s, 70s, you saw the financial services industry really start to expand as a percentage of GDP and really expand dramatically through the sort of 80s, 90s, and 2000s, up until about a peak in 2008. And in 2008, you started to actually see the percentage of financial services in the context of GDP actually start to shrink. And this was sort of the thing that sort of made me start to say, well, could it ever shrink materially? And sort of how could it shrink? And so was how could this change, right? We hear a lot about fintech, and over the last decade, fintech has become a much more prevalent area, of investment. So fintech is ultimately, financial technology, but it's sort of generally consumed by the kinds of companies that are attacking financial services around consumer or around certain parts of the agency that the industry is currently healthy on and living off of. And so what does that mean? Like, if you actually look at it, most of fintech today is built by, it's taking a consumer product and trying to make it cheaper. So, I'm going to give you a portfolio for half the price of what it would take to buy it, and get it from the bank. I'm going to give you ETFs, could be considered, call it a fintech. Wealthsimple is a fintech. All these, Robinhood is a fintech. They're effectively attacking at the agency. They're trying to marginalize the agency in many ways. Square, PayPal, all these guys are fintechs. But if you actually look at the product, they're just trying to create a better user experience or better product cost to the end consumer or the customer. The other part that's really important, though, is that financial services as a whole is jurisdictional. It's driven by regulatory jurisdiction. So, as you know, banks are regulated by their, US banks, Canadian banks, European banks. Yes, there's global companies like JP Morgan, but if you actually break down the company, it has a registration in the United States, it has a registration in Canada, it has a registration in, UK. It's jurisdictionally fragmented. And so it has an ability to kind of go after those markets, but it's not over the top of jurisdiction. And this actually comes from kind of the historical way of financial services being built, which is very community-driven thinking. But that reliance on jurisdictional also has really been a struggle for fintechs, because if you want to be a fintech player, you generally have to also apply under the jurisdictional model of attacking. Whereas when you look at something like Amazon or Google or very disruptive businesses, they are sitting over and above jurisdiction. Facebook is a global company, and it's centralized in one region. Google is a global company. Apple is a global company. Yes, they have distribution in different markets, but they are global in nature, and their customer base is global in nature. And so very different in terms of their ability to kind of attack the market and drive the change. Financial services, on the other hand, still has to rely on that jurisdiction. So, you still see European fintechs, you still see Canadian fintechs, you still see US fintechs, as opposed to a global player that is truly trying to change the industry and change the world. The most important thing, though, is that most of them have struggled in many ways because they are just trying to, marginalize the business. They're trying to win at scale. So if you've got jurisdictional restrictions and you've got scaling as result issues, but you're also trying to attack at the margin, in terms of I'm going to charge less or whatever it be, then it can become a very tricky issue, as you can imagine. So there's a lot of kind of balance. Some players break out of that and can build scale. Some players struggle with that. But the most important problem that financial services or fintech players have is that they still rely at its core on the existing infrastructure rails. And so what does that mean? Is that to be able to transact, you can go and play and pay with PayPal, but you still have to take your money from traditional rails, your bank account, put it into your PayPal account, then you trade in the PayPal environment, and then you might trade it back into your bank account. So you're still relying and paying the agency, credit cards. I can go build a really unique credit card company, but at the end of the day, I still pay 2/3 of the profits to MasterCard and Visa. And so the rails of the infrastructure have led to most fintechs just sitting on top as, call it, cosmetic businesses, with the infrastructure of the businesses still reaping substantial rewards and profits from agency. And so when you actually look at it visually, so you've got two actors, those who have money, those who need money, and all the profits. And yes, the industry is being attacked. Fintech is trying to attack and reduce the margin, but there is a theoretical limit to that agency, meaning that the need for the payments rails, the need for the currency and the SWIFT networks and all the banking infrastructure, all that agency is still today a limiting factor from reducing agency down to zero. So this is a very profound and important point, is that yes, we're going to cosmetically build better products and maybe better experiences, and we're going to maybe marginalize profits so that the bank doesn't make 2.5% on something, but makes 0.5% on something, whatever it be. And for the consumer, that's great. It's nice little incremental benefits, but there will never be, under the current model, a really big change in agency, because the infrastructure is structured, it's legacy, and it has effectively monopolies or oligopolies or whatever you want to call it. And that ultimately is critical. And then comes along crypto. And so The first and foremost thing is that crypto represents a reordering of all of this, because it is not about currency. It's not about, kind of this principle of I'm going to create a better way to basically transact, to give money between one person and the next, or, whatever it be, or buy things. It's about the rails. It's the simple concept. So if you get into what ultimately Bitcoin, it innovated, what the thing that mind-blowingly changed the order of things just on the original Bitcoin white paper, it was the principle that for the first time, you can, in a non-trusted way, or non-trusted environment, transact a certain amount of value from one person to the next without any intermediary. That is a powerful principle. So go back to what I said earlier. All of those rails are built on the predication that you need a trusted environment, or you need some trusted party to allow for value to be transacted between two parties. And so that is why they're there. That is the kind of the psychology of why they're so powerful. And when you get into a trusted environment, yes, two people can transact value, but when you environment, the ability to transact value between one party and the next, outside of the payments rails or the traditional rails that were out there today in the financial services industry, just didn't exist. And so Bitcoin created that. And it allowed people to now dream and think uniquely about the position of how you can create linear, call it non-agency transactions of value. Now, of course, what happened from there is it then opened up meaningful opportunity for innovation. So you've seen, of course, Ethereum came out next, and I continue to believe that Ethereum represents one of the most powerful and innovative principles of how do you take a linear model into a non-linear model so that you can actually now create, smart contracts and the fundamentals of any kind of form of value transaction to be occurred in a really unique, trustless way. And so this effectively is the first time we can now look at finance and value to ultimately be occurring off the rails of traditional finance. That is why it's so powerful. And for the first few years, when I sort of got involved and started to pay attention to this, for the first few years, what was going on in my mind was, this is so powerful. It blew my mind, but it's still a bet. It's still a meaningful bet on the opportunity for, can this scale? Can it prove security, which of course was already, you always felt the security was there, but can it prove security? And can it ultimately have the right governance model? And those are the things that you ultimately were solving for. And scalability in the case of something like Ethereum was the number one problem that it had to solve. It already had great governance and security. It had to solve for scalability, and it still has to solve for scalability. Other protocols and layer protocols have tried to solve for scalability through giving up governance or giving up security. But the principle is those three things. Can you create a model that is scalable, highly secure, and has really strong governance models? That's the key trick, right? And so my view was, if this can work, the asymmetry of this is so powerful because it can redesign the entire middle core of finance. And so when I get into it today, I love the Q&A, I'm just trying to give you directionally what's going on. I think that this is one of the most exciting experiments, and as academics and others in the room, I hope you get energized and excited about it too. This is one of the most exciting experiments that we will see in our history, in our lives. Take something like DeFi, for example. Decentralized finance is, of course, built on the principles that a non-human driven, more governance and algorithmic driven principles of structure and infrastructure are superior to centralized finance, human intervention based models. Of course, that's counter to what everyone who's centralized wants to believe. They believe that when the Fed speaks, that the Fed has the ability to control outcomes and is better to be nimble, and that their governance model is the best model. And governments, of course, think the same way, and everyone else, they all think that human-driven intervention is going to ultimately win the day. For the first time in our lives, we're actually going to be able to see in real time this experiment running in parallel. And I think it's going to be fascinating. And as an engineer, I actually think in my mind who's going to win this. I really do believe that decentralized finance will win this, and it will become a superior form of finance models. What I get excited about too in this is that, small teams have done some pretty remarkable things. If you actually get into, the details of some of the innovations that have been built so far between layer 1 and up. But what's really cool is that, like, the number of, call it, thoughtful engineers that are focused their attention today on building in this environment. I always say you want to follow the developers, you want to follow the engineers. And the smartest people I know today, no concern about the people around the room. I'm sure there's many smart people in the room. The smarter people I know are working in Web3 and in blockchain technologies today. And I think that's also an indication of where I think there's really some power. And I think this place is moving extremely fast. One really important thing about finance, and I didn't say it earlier, is it's also an extremely fragmented industry. There is no winner take all. We talk about these big brands like JP Morgan, RBC, and likewise, but if you actually get into it, they're very small players on a global industry. And so, JP Morgan's the largest bank in the world, let's say, but they have a certain small percentage of market share, like single digits market share. BlackRock, the largest asset management firm in the world with $10 trillion in assets, has a less than 5 or 6% global market share. So the reality is that this is a very fragmented industry, predominantly because of that jurisdictional construct, and it's an industry that has a very large swath of customers, of course, to serve the global economies and everything like that. And so as a result, like, the fragmentation of customers is very, very powerful. And so as you think about the mental models of how crypto and stuff will ultimately drive, the questions will be, will this remain a fragmented industry? Will the characteristics of traditional finance still retain themselves as you get into kind of more decentralized finance? Or will there be a more, single platform, winner take all mentality? I don't believe so, but it is a fascinating, again, reordering of structure of how the industry works today. In the next 5 years, most people would say, yeah, this is great. But like, what you see today is things like Coinbase, and you see things like, Wealthsimple crypto, and you see things like, we have our ETFs, and these look pretty much like what we see today, which is a brokerage and exchange. We see, an online, do-it-yourself platform, or we see an ETF. Like, they look pretty much like what you'd see in the traditional world. So is it really rechanging or changing anything? The answer is no, not yet. It is slowly making people more aware and giving people access. But today, I think in the next 5 years, what will mostly come across as innovation in crypto will still look a lot like traditional fintech, but it will effectively take crypto native capabilities, people who understand how to deal with on-chain execution, with mass market consumer adoption, and giving people confidence around safety and security, where they store their, effectively their personal keys and the custody of their assets, the fraud detection and managing of that, effectively giving people a really strong place to have confidence that they can interact and work, confidently with Web3, and also work with regulators. And in that sort of, call it, that intersection of those three will be where you'll see a large part of, call it, product and innovation, but it'll still be fintech like, right? It'll still rely on traditional finance and centralized finance thinkings and principles on product and such. But I think that what's really amazing is that I think when you fast forward beyond the 5-10 year mark, where the real change is going to start to play out post 5 years is that you are going to see a reordering of the construct. So, the principles that now we may actually see a redesigned model for the way we look at, algorithmic market making and trading, a redesigned model for, the way we look at applying, call it, sort of central banking theoretical models, right? All of these things, which are playing out today, they're happening today, but they're still in this, early user case test and the innovation that still has to be compounded on top of it. But I think over the next 5 years, you're going to see that adoption grow faster and bigger. The proof that they, as I said earlier, maybe superior models to centralized models. And then you'll see the innovation really start to get adopted more broadly. What has to ultimately happen is the linkages between, call it on-chain execution away from traditional finance. And so what ultimately will need to be built is product and businesses that are truly crypto native, like on-chain native. They have no interaction with traditional finance in any way. And when that actually starts to get built, then you can actually see some really important change. The best example, in my opinion, of a very basic way of reordering this is when you start thinking about central banks creating their own digital currencies. And I know that the first iteration of this, when I go back a couple of years and even up to about a year or so ago, was central banks saying, yeah, we're going to do this because we don't like Bitcoin. We're going to do this. Yeah, Bitcoin's irrelevant. We're just going to go build a central bank digital bank currency. And the reality is that, as you've seen, that message has actually slowed down. Why? Because they've realized that that's not the right way to think about this. What you're going to see is actual central banks start to build digital currencies, mainly because it gives them a way to disintermediate the agents. And what's the agents today? Is the banks. Today, the central bank acts as a wholesale banker, and their job is to ensure that there's proper order in the economy. And when they need to act as a intermediary or a supplier of capital or destructor of capital, they have two forms. Of course, interest rates, which we're seeing play out live right now, and liquidity, putting capital into the system. And so, how do they do that? They raise interest rates or decrease interest rates, and they also throw capital through the intermediaries, the banks. So they put more capital onto the availability to the banks to lend out, or they restrict that capital to reduce the amount of capacity the banks can lend out. But their agent in the middle is the banks. Best example, we went through COVID, and the central banks had to get capital into the markets, into consumers' hands, to sort of offset the risks of the economy and the slowdowns or shutdowns, and to small businesses and other corporate commercial businesses. And what do? They use the banks as their distribution angle. If you have a central bank digital currency, now you can actually have everyone have their own wallet. And when you want to get money into the markets, you can get money into the markets directly. No intermediary. You can do that in seconds. You can just pump money into the markets, and you can pump money back out of the markets. The principle of this is that the banks become irrelevant. And I use that word somewhat cautiously because I'm not that draconian, but they become less relevant to central bank actions. So that simple principle should be very, very fearful for traditional incumbent agents in the business. So there are lots of questions on this. Where will the profits be? Where will the industry ultimately accrue value? There's really exciting things, but the first thing that most people do, I'll just say, is when you start talking about mental models of the kind of reordering and redesigning of things, is they try to apply the existing way that we do business and apply it to the future. And the reality is that's not the way to think about it. We actually have to reorder our mental model of how profits and structures and value will be created. Second is how will companies be organized? This is a fascinating one. Those of us who spend time looking at DAOs, they are ultimately just an organized structure, right? Will DAOs become more prevalent as a form of call it corporate structure or organizational design? Or will we retain for-profit models that we see today? And then jurisdiction. There is no jurisdiction in crypto, theoretically. And so one of the beautiful things is this becomes over the top of jurisdictional regulation in some ways. And so how will that play out? How will the regulators react to that? How will a bank in the future look if it doesn't have a Canadian arm and a US arm, but rather it's a global bank that centralizes on a main head office somewhere that people operate, or even just a set of governance structure, and it now provides liquidity, provides capital, does asset management, but never ultimately sort of lives on the ground in jurisdiction, but up in the cloud. How does that look? And what's the scale of that operation? And one of the really exciting things, just to before I jump off to Q&A, is one of the things that I got really energized about a number of years ago was this construct of community-based banking. And so when I think about what social media did, and so let me step back for a second. When I think about like what community-based banking is, so the original thesis, when most people say community-based banking, is jurisdictional, right? So, go back to the 50s and 40s, banking was your jurisdiction. You'd have a bank in your little town. The bank would service the customers, and the only thing that you had in common, or the bank had, was servicing you based on, was the commonality of your community. You just happened jurisdiction to live, 1 kilometer away from the bank, and so did everyone else who was a consumer of that bank. And then, of course, you started to see those community banks become more, regional banks, and then, of course, jurisdictional banks like U.S. Bank or Canadian Bank. But ultimately, it still relied on this principle of people having jurisdiction. So because RBC is a Canadian bank, and that's where I keep my Canadian bank account, and that's where I do my credit cards and all the rest of it. Okay. But I have no other alignment. Maybe I choose RBC versus another bank or whatever it be, but that's my alignment. It's just they happen to be the bank that I bank with. Actually, I work there. And so I bank with them. But when you actually step back and look at what social media did, social media changed jurisdictional thinking. Community used to be, I used to have my social community as well. I used to hang out with my friends, and the only thing I had in common was they were my neighbor, or I, went to the local church with them, or, I was, effectively had a common value that aligned. We'd show up at some coffee shop together and hang out. But at the end of the day, that was my jurisdiction. What social media did was it lifted jurisdictional community out and now on values. So this idea that I can now have a community of friends and social network that was based on my interests or my engagement anywhere globally. I mean, you could theoretically have a community because of Facebook today of 10,000 people that love, cats with white stripes on them. Like that's a community. And there are, there's 10,000 people in the world that love cats with white stripes, and they could buy things together, they could talk, and they could buy, do book clubs together. They could do a lot of really cool things. They could be an actual consumer or a band, right? In many ways. And Facebook allowed for that. And so when I look at banking, and I sort of say, or finance, and I say, wow, like I'd always said that there was this really exciting opportunity to create non-jurisdictional community-based values banks. So the idea of like, how about an urban bank for those who, actually are not taken care of properly, or a LGBTQ bank that had a set of values that serviced products for the LGBTQ community, or frankly, a bank that was effectively for those, 10,000 people in the world that loved cats with white stripes on them. And so the thesis of it was really energizing, but the execution was impossible. Execution was because how do you build a bank that can service 10,000 people around the world? That's not scalable enough. And frankly, you'd have to have multiple jurisdictions of regulation and all that stuff. And now with crypto, you don't. For the first time ever, you can actually create community-based solutions that actually target a very specific set of customers or consumer values that actually can redesign the entire construct of the way we think. So that's why I get excited. And that's real change and innovation, because now you can design products and ideas that actually solve real life problems. And so anyways, let's pause there. Chris and the team, I'd love to answer questions and open it up.